Welcome, everyone, to another episode of Mortgage Insiders Edition. My name is Kim Nguyen, and with me, as always, is Preet Singh. We're mortgage brokers with the Vine Group, and today we're going to talk a little bit about what is going on with this market when it comes to interest rates, the economic data, and especially for those of you who are in the market right now to buying your first home, second home, whatever home it is. What are some things that you may want to keep in mind?
Absolutely. Welcome everyone to another edition of Mortgage Insiders Edition. This is a very basically interesting time in the mortgage market. Many forecasters are predicting that the interest rates will start going down very soon as expected in the coming year. Some people are even projecting early spring market, and let's see how it plays out. But they're very um, important points that we would like to share with our audience, or especially the buyers, if they are in the market looking for their first home or second home. Even I would say, even for the renewal clients, also it may fit in somewhat of the rate discussion, right? So, Kim, what exactly are you advising your clients today when your clients are approaching you and asking you the most important question: what is the interest rate advice? Like, what are you what kind of benefits, pros and cons? What How are you basically explaining it to them?
hmm I think, like, first off, I always like to explain what is going on in the market first, right? The fundamentals. Because right now, when we're looking at interest rates, we've been in a period where we're facing severely high interest rates, right? So
Mhm.
this is known data, and this has been the case for the last like year and a bit, right? So what's going on right now is, as you know, Bank of Canada has a main mandate to control inflation. That's always been the
Mhm.
goal. So when inflation is controlled, that's when we see rates come back down. So what we're seeing right now in the market is we are seeing inflation cool down. We're also seeing unemployment go up. And then we're also seeing a slowdown of the economy, which is the perfect storm in the Bank of Canada's eyes. So, with that being said, that kind of puts us into a recession, a period right now. So, we're probably at the beginning of it. So, what I'm usually telling my clients is because we are in that recessionary period, usually it takes about 1 to 2 years for the full impacts of interest rates to hit when we're in a recessionary period. So, for those of you who are buying a home or if you're renewing your mortgage, refinancing, my suggestion is to look into something short term because we are going to see rates come back down. So, whether you're doing like a 1 year term or a 2 year term, again, both really good options. I wouldn't suggest going anything longer than 2 years term. And in fact, like I might even throw out a variable rate. And I know, Preet, you and I are both huge fans of variable, right? And I think maybe you can elaborate as to why variable may make sense in this kind of market.
Absolutely, yeah. No, I am a big, I would say, advocate of a variable mortgage rate or adjustable mortgage rate, hands down. That's my go-to product, and I always advise that product based on a couple of strengths. First one, in the variable mortgage, you as a consumer or the mortgage holder has a 365-day freedom. You can wake up any day, anytime, any morning, and you can decide, okay, I don't want to stay in a variable mortgage and I want to convert the variable day mortgage into a fixed mortgage. You're not bound by any anniversary date or a renewal date, or per se, let's say, a commitment period. So any day, anytime, you can call your bank, existing lender, or you can even move from a variable rate to a fixed mortgage with another lender. We will talk about that, the other advantage also. That is the biggest freedom, flexibility I like about variable product, right? It gives the consumers the freedom. The second thing that I really love about it is, in a variable product, we have said many different times, I will again repeat it in bold: the clients control the penalty, the consumer controls the penalty. It's 3 months interest penalty, and that simple rate, simplest interest calculation, we all learned it in grade 3 or 4, how to calculate a simple interest rate. If you calculate a simple interest rate 2 a.m. at midnight, and or 3 a.m., and you call your bank lender in 8 in the morning, that number would be the same on your calculator and what the lender is telling you, because it's the simplest calculation, right? So in this case, variable rate mortgage, per se, if any reason you have to break the mortgage, you're moving out of the country or changing lenders, or you have, let's say, inheritance coming in, lottery winning, and you want to pay off the mortgage in full, most welcome. All lenders will charge you a 3-month interest penalty, simplest calculation. But in case of a fixed mortgage, you don't control the penalty. The penalty is controlled by the lender. It could be the greater of either the 3 months interest penalty or the interest rate differential, IRD in short, right? So that IRD is explained by all lenders on pretty much on their websites, and it's a complex formula. It's there are a lot of many variables into that, right? So these are the two prominent reasons why I basically am an advocate of variable mortgage. Only I would go back to one main thing. Only thing that you have to do in a variable mortgage when you're converting from variable to fixed is you have to complete the remaining term. So if you were, per se, example, you were in a 5-year variable term, and year number 2 you decide to convert it into a variable to into a fixed. Remaining term is 3 years, so now you have to take a 3-year fixed or higher with the lender. And you can, as I said earlier, you can break this variable mortgage and go to a fixed lender, go to a fixed rate with another lender also, just by paying 3 months interest penalty. And that's basically sometimes very much beneficial for a customer, and the math totally works out in the client's favor even after paying the 3 months interest penalty. Yeah.
I think like the one thing too that is such a huge benefit when it comes to the variable, especially in this economy, is that rates are coming down, right? So as Bank of Canada drops rates, and we're even hearing that Bank of Canada may even look at dropping rates as early as April of 2024. So in,
Yeah.
like I said, 5 months time frame, right? And if you have a variable rate, what's cool about that is as rates come down, you're going to benefit from that, right? Like you're going to see effectively your rate go down. So you're basically riding it out. And then let's say, you ride it out for 2 years, and now we're at a point in time where the fixed rates are also pretty low, or back to normal. At that
Yeah.
stage, if you want to, you can, like Preet said, you can always convert it to a fixed rate term, and there's no penalty. So it is something to kind of keep in mind, for those of you that are shopping today, for you buyers, or anyone who has a mortgage coming up for renewal. Look into those strategies. We always have a saying here at Vine, which is you want to date the rate and marry the home, right? The home is the most important thing they can't break up with, right? But when it comes to an interest rate, like I said, you shouldn't be locked in long term. Look into something short term, ride it out as things come down, because they will come down. And that's kind of the main suggestion that we're advising most of our clients right now, anyways.
That's good, Kim. One other thing I would just an educational piece I would add on over here is the clients should basically watch the Canada basically 5-year bond yields. They can Google it up. Many different websites comes up, and that's the indicator of the fixed rate markets, right? So they can watch that number. Yes, many other mortgage websites talk about Bank of Canada announcement dates. So those announcement dates are basically aimed towards the variable rate announcements, right? So, but fixed and variable rates, they're not basically tied up to each other, right? But they follow each other. So there could be too much different, other than Bank of Canada, basically source, you can look at bond yields, how the bond yields are behaving in a market. And that will also give you some idea. Like many different websites show you a 1-year graph or a 5-month or 6-month graph, and that gives you a good idea where the bond yields are. That's some good indicator also. Other thing that comes to my mind is, as Kim, you already said, 2-year fixed rates. So many clients who would still not like to go into a variable because of the fluctuation or the risk associated with that. So then 2-year fix is also a good option. Maximum 3 years if you really want to secure and keep yourself up to date. Then 3-year fix is also a good option. Definitely, many lenders are giving us good promotions on 3-year fix right now. Yeah.
Hmm. Yeah, so I think at the end of the day, reach out to your local contacts, especially if you're shopping around or you've got that renewal. Now's the time to shop around, right? Make sure you don't just look into one option. There's a ton of different lender choices out there. And again, you want to make an educated decision, right? Learn where the
Absolutely.
trends are going. And again, but most importantly, too, it has to fit your lifestyle. So, but
Yeah. Yeah,
mhm.
like even if your mortgage is coming up for renewal, we always advise our clients to start the process 4 months in advance. And we will go through your numbers at that time. We will look at your income and property equity and everything, and maybe advise a HELOC, home equity line of credit to consolidate debt. Maybe if it's not needed, maybe it is for future use, buying a rental property with that home equity line of credit. There are different options. So what Kim said is, consult a mortgage broker like us. We can review your full scenario and no obligation. And if everything works out, we can definitely guide you to the new lender. And if it doesn't work out, we would be very upfront with you and say, yeah, we don't see the reason why you should leave your lender, or let's say the income is not up to the mark, or some other reason, credit is not that there, then we will advise you to stay with the current lender. Then at least you will have done your math, you have looked at all the options, and you will have basically done a logical decision at that time, rather than going back to walking into your branch and locking in into the rate, whatever they offered you, right? So call a mortgage professional, a broker, and they can help you out.
As always, our contact details are shared below, and we'll catch you on the next one.
Okay, thank you guys.